Jesse Lipscomb here, enrolled agent and investment advisor. I basically specialize in tax planning for real estate agents and real estate investors. We're going to talk about 2020-21 tax updates, as well as some tax strategies that your sellers may need to use, as well as strategies for you, the agent. Here's a quick overview. Remember back last spring, people were getting $1,200 per person with stimulus checks. Then in December and January, it was $600. Well, literally this week, it was announced that if you're making $75,000 or less single, or $150,000 or less married, you'll receive another stimulus check of $1,400 per adult. And this is different. This is different than before. It's $1,400 per dependent on your return. Now, the reason I have recovery rebates at the top of the screen is that on the 1040, they've made an allowance for people that maybe didn't get the first stimulus check because their income was $200,000 or $300,000 in 2019, and they didn't file their 2020 tax return. So the bottom line is, if you're due the rebate and you didn't get it, you can claim it. If you never got your stimulus check, you can claim that as a recovery rebate right there on your tax return. Pretty nice deal. The e-filing season, it began on February 12th. That is horrifically late. Normally it opens up in mid-January, and it has a lot to do specifically with that recovery rebate and adjusting the tax forms to be able to facilitate this. As of right now, late breaking news, the first $10,200 of unemployment is now going to be tax-free. So if you've already filed your 2020 tax return and you had unemployment last year, it may be in your best interest to file an amendment. Also, the S Corps, C Corps, and partnerships, they've been up and running for a good while now. A lot of folks received a payroll protection program, a PPP loan. The new version 2.0 is probably it's probably not going to be practical for most agents, and the reason why, believe it or not, a lot of real estate agents had a great 2020. Their 2020 numbers were substantially greater than their 2019 numbers. And in order to qualify for PPP2, one of the big caveats is you have to have at least a 25% decrease in total revenues, 19 to 20, either annually or any quarter. So even if you had a great year in 2020 compared to 19, maybe you had a bad second quarter. And if you had a bad second quarter and you're either self-employed or incorporated paying yourself on a salary, if you can prove that, you may be eligible for the second PPP. It's just not as easy to get as it was back last year. The EIDL disaster loans, we're about 2 months out right now from the first year of deferred payments starting to kick in. So if you received one of those, a lot of people got $20,000, $30,000, $50,000. I know some people that got $100,000. The terms on that, 30 years, 3.75. SBA is going to be reaching out to you to get a resolution on file. And actually, depending on the loan amount, you may even need to get business insurance. But the bottom line is the payments are going to start happening here pretty quick. Let's see. So Sam asks a question about to transfer the base property to a new home. I'm going to talk about Prop 19 here, about 5 slides, and I'm going to come back to you on that, Sam. Unemployment benefits, again, late breaking news. It's been bumped federally for an extra $300 per week through September. That was about to expire in March. And IRA withdrawals. This is the biggest deal. If you took out up to $100,000 in an IRA or a 401k last year before December 31st, you'll actually have up to 3 years to either claim that money as taxable income or to pay it back without penalties. So that's kind of nice. And they bumped up minimum distributions as well now to age 72 as opposed to 70.5. Okay, Prop 19, here's back to Sam's question. Prop 19 made a huge change to several long-standing California propositions on property taxes. The 55 plus provision basically, and this is a great guide for you guys, boe.ca.gov/Prop 19. You just Google BOE Prop 19, but these charts are great. They're going to show you the changes. Now, the 55 plus part of Prop 19 is tremendous for homeowners, okay? And the bottom line is, under Prop 60, you used to have to downsize essentially to be able to transfer your low property tax base. Now under Prop 19, even if you go up in value, you can still transfer your low property base. You just pay taxes on the difference. So super, super easy numbers here. Let's say that you bought a house for $500,000, okay, and you're paying property taxes based on that, and you sell it for $1 million. Under Prop 60, you'd have to buy another $1 million home to transfer your basis. Under Prop 19, you could buy a $1.5 million home, okay? And you'll be able to transfer your $500,000 basis. The only thing is anything over your sales price is also reassessed. So you'd have your $500,000 original plus the difference, which happens to be $500,000. So you'd be paying property taxes on $1 million instead of 1.5 million. It's still a pretty big savings. Now, Sam is alluding to qualify for the transfer of the base property tax to a new home. Do I have to buy, or can I use one of my rentals and move into that? Okay, so one of the caveats to this is if you sell your primary residence, and let's say you lock in the $500,000 capital gains exclusion, right? Can you then subsequently turn around and use one of your rental properties as your new home? So the guidelines on BOE say that you have to either purchase it or build it within 2 years of the sale. Now, the old Prop 60 would also allow you, if you bought the replacement property prior to the sale, to transfer that. Okay, so let's try to answer a couple of these here. In Sam's situation, I'm going to say I might have to get back to you on that one, just because it's my understanding that you need to acquire the new property under Prop 19 within 2 years of the sale, as opposed to prior to the sale under Prop 60. So that's a great question. Jenny asked, where to report to get the new property tax? So that a couple different things happened. If you guys are familiar with, here, let me pull up Google real fast. A PCOR, as agents, a PCOR is something that every time you guys sell a property, the PCOR is sent through escrow, actually. And what it is, it's the primary change of ownership report, okay, or preliminary change of ownership report. It's where you try to get the various exclusions. Now you're going to see here on the county assessor's office, they've actually changed the forms where now you've got the parent-child exclusion. Okay, this is basically what the change of ownership report was before and after. So that I think Prop 19 is actually going to change up a lot of the forms that folks are using. Okay, so now that kind of is a synopsis of some of the 2020-21 changes. Regarding strategies for that, what do you guys think? Is it a good idea to sell my home today? I would think so. I think so. Property taxes are all-time high. Inventory is very, very low. And so to that end, what are some easy tax strategies? Well, the Section 121 2 of 5 year exclusion is still there. Back in 2018, they're going to change it to 2 of 7 years, but they kept it. But what happens if you have somebody that bought a house a year ago and has to sell? Maybe they get transferred from work, maybe they have to take care of a family member, or maybe they fall into the category of an unforeseeable event like becoming eligible for unemployment because of COVID. In that situation, there's an exemption where, let's say they bought the house in March of last year, they're selling in April of this year, they've got a $100,000 gain, but they lost their job. Okay, so they didn't make 2 years. What the IRS will say is, okay, well, how many months were you in it? 12 months. 2 years is 24 months. So 12 and 24 is 50%. They're going to take 50% of the $250,000 exemption and say, okay, well, you can protect $125,000 of your equity because you lost your job and filed for unemployment. That $125,000 is more than the gain. So in this situation, they wouldn't have any capital gains taxes due. That's a nice situation. Okay, regarding the rules change, this goes all the way back to 2008. Okay, in 2008, the rules with Section 121 changed, where any time that you have your home as a rental will not count towards the $500,000 or $250,000 exclusion. So let's take a look. And by the way, I put this right in big letters. Don't move in to a rental to try to protect it from gain. Here's a very, very easy example. Your client buys a house in 2010 for 100 grand. They have it rented from day one, 8 years as a rental. They want to sell it, but they decide to move back in for 2 years to get the 2 of 5 year exclusion, right? There's $500,000 gain. They're thinking they're not going to pay any taxes, and they are incorrect because the IRS is going to say, listen, you owned it for 10 years. That's cool. But you had it rented for 8 years. That's 80%. So 80% of the $500,000 gain, which is $400,000, is not eligible for the exclusion. In fact, only $100,000 is eligible. And the problem is that $400,000 gain on your primary residence at this point is going to be about $130,000 in taxes. That's no fun. So what do? Well, in their situation, they're kind of in a pickle if they're primary because you can't 1031 exchange a primary residence, but you can 1031 exchange rental properties. And all in exchanges, you're selling one house for another, or you're selling one house for multiples, right? I think as agents, one of the opportunities you guys have is to go back to Prop 19 and the parent-child exclusion and realize one of the core tenets here. And that core tenet is this, that if your client has a rental property, now, February 16th and forward, if they have a rental property, they pass on, that property is going to be reassessed for property taxes. And if they've owned it a long time, you may find that the property taxes go from a couple $1,000s a year to $10,000 or $15,000 a year. And so if the goal is to give their kids a rental property, maybe what they should do is 1031 exchange $1 million California rental for 4 $250,000 brand new properties in like Houston. Okay, now why? Because out in Texas and the Midwest, you're probably going to get a higher cap rate than here. You'll defer the taxes, and from an inheritance standpoint, you'll be passing on, basically low or maintenance-free properties, okay? One thing to keep in mind, though, if you do 1031 out of state, California has a form called a 3840, and that sticks with the homeowner until they die, donate the new property to charity, or decide to pay taxes on it. It's pretty crazy. You're connected to California for life on that. And unfortunately, the FTB is infamous about sending out notices of proposed assessments. By the way, you can see at the bottom of the screen, I got this directly from California's Franchise Tax Board website. A notice of proposed assessment is where they basically just make up a number and send you a bill. And I know that sounds ridiculous, but it's kind of how it works. And so the way to protect yourself is literally just to file that information form every year saying, yes, I still have the exchange property, okay? Now, what if your clients say, I'm tired of toilets and tenants and trash, and I want to sell my rental, but I'm going to pay too much taxes if I sell? Well, an old strategy is the old Section 453 installment sale. And the idea here is, we should call these seller carries. If you have a $500,000 gain and you get $50,000 of payments on it for 10 years, what happens? Well, let's say you're married. The first $80,000 of income, capital gains wise, is taxed at 0%. So instead of paying $100,000, $150,000 in taxes on that $500,000 gain up front, if you can structure the gain over 10 years, say, you might not pay any taxes on that. I know if we think about this, there are two negatives with installment sales. Number one is, my God, with the default, now I've got to go and foreclose on the property. And number two is, well, what if they prepay you? If they prepay you, then the tax strategy is screwed up, because if they pay you $400,000 lump sum, you're paying taxes on all of it. So the solution is, I'm part of a team, part of a group called the estate planning team. It's a nationwide group of tax and financial and attorneys. And basically what we've done is we've given the opportunity to create a business trust where the seller sells the property to the business trust in exchange for that note, that Section 453 note. They just simultaneously sell the property to an outside buyer for cash. So what you have thus is cash in the bank, literally, to pay the note. And if we look at it, we did a couple of these in Lemon Grove over the last couple of years, which are all like identical. They're all about $400,000. The real estate investor invested about $100,000 to acquire them, and they're $300,000 gains. Well, if you have a gain in a rental, it's going to be taxed at about a third. So in this case, it was $100,000. Okay, and if they took the $300,000 proceeds and got 3% interest on it, that's like $750 a month of income. But through our deferred sales trust strategy, we're looking at a 12-year note of principal and interest designed to keep these clients in the 0% tax bracket. And by doing that, we give them $2,500 a month more income and potentially substantially less taxes. Sam asked a great question. It says, is the $80,000 capital gain exemption for married for real property only, does it apply to stock? Yeah, Sam, it's anything. It's stock. It's any capital gain. Let me give a kind of a tap dance here, not a tap dance, but a clarification. Okay, when you look at taxes, the way it breaks down is your taxable income is a function of all your income, your adjusted gross income, minus either your itemized deductions or your standard deductions. To keep this super easy, $80,000 plus $25,000 for the standard deduction means proceeds from stocks, proceeds from the sale of real estate, your wages, and your Social Security. If all of that adds up to $105,000, then the taxes on the sale of your long-term capital gains, real estate and stock, will be taxed at 0%. If you're over 105,000, any overage will begin at 15% or 20%, just depending upon your overall situation. Okay, but this is the long-term capital gains tax brackets. Okay, so that pretty much summarizes tax strategies for your clients using Section 121 to if they need to sell within 2 years, using the unforeseeable events exclusion. If they have $500,000 of gains, they can combine that with Prop 19. What if you bought the house for $500,000 and it's worth $1 million? You could sell it, lock in the $500,000 gain, literally go RVing for a year, come back and buy another $1 million property and transfer the $500,000 basis. Why? Because you have 2 years under Prop 19 to transfer your basis. Okay, so that's Section 121. Section 1031. You can literally split your gains from one expensive West Coast property to several potentially brand new Midwestern properties. Okay, or you can go from a $1 million single family residence to $1 million apartment building. Okay, it's all about cash flow for on that. And then lastly, if you have a client who's just tired, they want out of the game, they don't want to deal with toilets, tents, and trash, they need the income, take a look at the Section 453 and the deferred sales trust. We may be able to help them defer their taxes while enjoying the income and not having to worry about tenants anymore. The last section of this workshop is actually for you guys. And I want to share with you a little graphic here on what my most successful clients do. And this is mostly observations of mine over the last 20 years of helping people with, tax and retirement situations. If you're self-employed and you're making over $60,000 a year total income, you got to set up an S corp, because it's all about controlling the amount of Social Security and Medicare taxes you pay. You then take those savings and save them for retirement. Okay, why? Because it's so easy. If you're in the 24% tax bracket and the S corp saving you $10,000 a year of Social Security and Medicare taxes, put that 10 grand into your 401k. You'll save an additional $3,300 and have more when you retire. Simultaneously, they're going to use their good income and their good credit to grow their business, as well as to acquire rentals. And then you get more money coming in, which means you can save more money and have more money. Okay, that's an overview of best practices. So regarding lowering and controlling your taxes, so I know you all are self-employed, but just going back a little bit, the last time you had a job, you have gross wages of $1,000. You're going to pay $62 in Social Security and $14.50 in Medicare. That's 7.65% of your paycheck, and that just comes right out. What you'll never see is that your employer has to match that. Well, you'll never see it until you become self-employed, and then you get to be your own employer and your own employee, and the IRS still expects that 15.3% per $1,000. Okay. Now, if we're going to calculate the self-employment tax, can do, JC. All right, appreciate that. So if we're going to calculate self-employment taxes, let's take a look at profits of $72,000. Okay, being self-employed, you get a little offset because employers can deduct payroll taxes, and then you multiply that times 15.3%. So if you have $10,000 in self-employed earnings, or excuse me, self-employed taxes on $72,000. Great. But what if you paid yourself $2,000 a month in an S Corp and had $4,000 a month of profits? It's the same $72,000. The only difference is you save $6,500 a year in taxes. Okay. Kevin Burke is the best. All right. I'm going to share with you the easiest financial strategy I've ever learned. And it's this. $500 a month at 5% interest equals $200,000. Okay. That, if you're 40 years old and you want to retire at 60, 45, 65, $500, 5% interest, 20 years. That is doable for everybody. If you're 50 to 70, whatever, right? But it's scalable. $1,000 a month in 20 years is $400,000. $1,500 is $600,000. Why am I telling you this? I'm telling you this because if we start coordinating these strategies, and on average, you're making, say, $100,000 a year total income, writing off about $30,000, there's your $72,000 of Schedule C income. $24,000 in wages, $48,000 in pass-through. You're saving the $6,500, and the beautiful thing there, that's about $500 a month, right? So if you just save those savings, what happens? You take that $6,500, you put it in your own retirement account. This is 0% interest. You've got, in 20 years, it's $130,000 of money you've given to yourself as opposed to the government. That's over $250,000 spread. Plus you make a little interest on it and it gets better and better. Okay. This is so important that you do that. You got to get time on your side. And as self-employed professionals, we've got to get control. Like, we're self-employed because we like to control what we do, right? Virginia has a great question. She says, if you set up an S Corp and you pay yourself a salary, isn't part of the tax saving offset by having to pay workman's comp insurance? That's a great question. So workman's comp is typically paid by your broker. You as an independent agent, no, you don't pay workman's comp on yourself. Okay, you're using an S Corp as a basically a tax strategy. Now, if you hire employees, yes, you'll pay workman's comp, but you don't have to pay workman's comp as an owner employee. Okay, so the solo 401k, all this is the one woman operation and corporation, the one man band 401k. Is even without incorporating, if you're a licensed agent, you're a business. If you're a business, you can sponsor a 401k. If you set up an S corporation, the S corp sponsors the 401k. You take some of the profits, you pay yourself a salary, and then, again, try to get at least that $500 a month going in. Use the S corp savings to fund your retirement. Okay. Next here is, I know most of you have heard of SEP IRAs, and there is nothing wrong with the SEP IRA. It's just, it's what self-employed people do. It's not what S Corp people do. Okay, here's what I mean. If you had $100,000 of self-employed earnings, and you're going to pay nearly $15,000 of self-employed taxes, you can then put $20,000 into your SEP IRA self-employed. But when you become a corporation and you're paying yourself a salary, the bottom line is you want to keep that salary as low as reasonable to minimize the amount of Social Security and Medicare taxes you're paying. So to that end, a solo 401k and or a SEP IRA have the same exact components. You can put in 25% of your wages into the plan. but only a 401k allows you to be your own employee and contribute $19,500 if you're under 50, $26,000 a year if you're over 50 into the plan. So look at this. On a $30,000 salary, you can put away $27,000 into a 401k as opposed to $7,500 into a SEP IRA. So it's just, SEP IRA is great if you're not a corporation. Once you become a corporation, it's better to better utilize a 401k. David says, what bank pays 5% interest on my money? Oh, that is a great question. No banks do anymore. No banks do anymore. But you know, it's interesting if you look at 20 years in the stock market. You know, I remember in 01 when I first got licensed, we would talk about, oh, it's, you know, the stock market's done 12% for forever, right? Yeah, right. But if the average investor in the long run in the market is averaging 5 to 7%, I think it is very reasonable to say that, you know, if you put your money away over a course of 20 years, just in a conservative 60-40 portfolio, I think 5% net of fees is conservative. It's not, you know, aggressive. It's not saying you're going to get 12, it's saying 5. So Sam has another good question. Can this go into a Roth IRA? Absolutely. And what Sam brings up a question that has bedeviled people for years. What's better? Is it better to put your money in a 401k that's deductible, or is it better to put your money into an IRA? Or excuse me, what's better, deductible or non-deductible Roth? I'm going to share with you, this is my opinion. I think it's just math, okay? If you're going to be married making less than $80,000 a year taxable income, you're in the 12% bracket. That means if you put in 10 grand into a Roth 401k, or you and your spouse put 5 grand each into a regular Roth, or excuse me, if you put $10,000 into a 401k or 5,000 each into a traditional IRA, 10 grand at 12% is only going to save you $1,200 in taxes, right? So therefore, it's better to just go with the Roth option because you're really not getting any benefit. But if you're up here and you're married making $500,000 a year, my goodness, you're at 35% federal plus at least 10% state. That means half of your 45% of your income is going to taxes. And so to that end, you know, I think if you're in the 22% bracket or higher, it's very advantageous to get those tax deductions, because this is just the Fed. For easy math, you can put another 9 or 10% for California on top of that. Okay. So now the last part of it, and you know, I really believe that words have significance. Earlier on, I said very specifically that my most successful clients do this. They set up S corps, they save for retirement, and they invest for cash flow. And I want you to think about that. If you don't have to go 401k and then rental, you can go rental first and then 401k later. But the concept is, how do you control your money the best? Using the S corporation is going to free up $5,000, $10,000, $15,000 a year of self-employment taxes that you would have paid in taxes anyway. Best to save those for the long term. Utilizing your good income and good credit to get current cash flow out of rentals, I think is very powerful. And we're going to talk about that here next. Let's talk about getting your first property. Okay, if you're a veteran, you can go 0 down. FHA is 3.5% down. You know, I think the best thing you could do when you buy your first house would actually to buy a duplex or triplex or fourplex, because then you're immediately in the game as a real estate investor. By the way, if you're putting money in that 401k, let's say you put away $25,000 a year into a 401k. There's $50,000. If you're in the 40% total tax bracket, which you get there pretty quick, you have just saved $40,000 in taxes. To be able to go out of the 401k and take $50,000 tax-free, that seems like a powerful strategy. Okay, how do you get more properties? Well, you can, if you start with a multifamily, then you can go back to a single family. That's easy. You can refinance your single family residence and put 30% down, and or you can 1031 exchange a rental. That is kind of a fast and furious overview, but we talked about, again, what my most successful clients do. And by the way, this is, if you read Rich Dad Poor Dad and Cash Flow Quadrant, The Millionaire Next Door, these are all real solid financial strategies. Okay, deferring taxes, controlling your taxes, getting passive income, building equity. Okay. Again, this is a recap of the entire workshop here. I think we've been answering questions as they've gone along, but do you guys have any specific situations that you might need any help with? Okay, well, no worries. Jane, I think we are, I think we're good to go right now. Oh, we got another question here. What does it cost to file an S-Corp? Carol, we charge $1,099 to set up S-Corps. And with that, I mean, you get a lot of bang for your buck. We're gonna give you the W-9, the tax ID, the articles of incorporation. We're going to walk you through the minutes and the bylaws. We're going to set up an accountable plan. We're going to issue your stock. We're going to help you file your S-Corp election. And 30 days later, we're also going to give you your first actual board meeting to make sure you're on track. I think you can go to LegalZoom and do it yourself for about $800. But just in my experience, if you value the help of a professional, that extra couple $100 is usually pretty helpful. All right, Kevin Burke, the best way to get a hold of me is through the website roadmaptax.com. If you guys have heard from me in the past, I've got a couple of videos here. I mean, a lot of good resources. But if you look into the social media tab, if you want kind of a laugh, take a look at my 2021 tax surprises. That's pretty good. But to contact us, I have a whole team here in Mission Valley. Roadmaptax.com, client care at Roadmap, and Rachel can get you set up. Can we get a copy of your PowerPoint? Yeah, sure. Nancy, we can do that. I can and give it to Jane, or if you send an email to Rachel at roadmaptax.com, client care at Roadmaptax, we can get that for you. I do not help agents set up living trusts specifically. We set up deferred sales trusts with clients who are trying to take advantage of the Section 453 deferred sales trust. But we just don't engage in living trusts. Virginia, I do believe this is being recorded. And like I said, if you just send Rachel an email at client care Roadmap Tax, or I can give them to Jane as well. You guys are happy to utilize the slides. In fact, I can make them into a PDF if you like. Okay.
Awesome, Jesse. I will go ahead and email a copy of the slides to everybody who attended today. And then we also will have the recording available on our YouTube page. That's the SDAR YouTube page. There's a library of education and resources. You can check out Jesse's other webinars that he has there on Prop 19. Yep, we have those available too.
Oh, perfect. Oh, I appreciate that, Jane. And then Sam actually has another question. He says, so theoretically, one can split the investments when selling and avoid capital gains tax to up to 80,000 a year. Kinda. It's not $80,000 per stock or $80,000 per property. It's $80,000 taxable income. So without getting too off track here, I'm going to pull up the 2017 Form 1040. And the reason why, only a tax guy would say that this is easy to read, but it's a lot easier to read than the new one. The 2017, you have your wages, you have your business income, you have your rental and S Corp income, and you have your capital gains. You add all of that up, if this is total $105,000, when you go to the back page and you go in, now the standard deduction is $25,000. There's no exemptions, and you have $80,000 of taxable income. If your taxable income is $80,000 or less, then any long-term capital gains are taxed at 0%. If your taxable income is in excess of 80,000, it'll be taxed at 15%, although quickly assessed additional taxes over 200,000. If you're single, 250 married for the Medicare surtax, and then it'll hit 20. So it's not a perfect situation, but it does work. It works really well in some situations.
Need more help? Contact SDAR Member Services at 858-715-8040 or membership@sdar.com.